Alright, if you've ever looked at a financial chart and just felt lost, you're on the right place. Today, we're going to pull back the curtain on the single most common tool traders use to figure out what the market is doing. We're talking about candlestick charts, and we're going to break it down nice and easy. So you look at a chart like this, and what do you see? At first, it just looks like a bunch of red and green bars, maybe some kind of weird secret code. But that's exactly what it is. It's a language. And just like any language, you just need to learn the alphabet. So in this explainer, that's what we're going to do. We're going to learn the alphabet of the market, one candle at a time. So let's start with the absolute basics. You see, this whole complicated chart is just built from one simple thing, a single candlestick. Think of it as the letter A in our new language. Okay, first up is the main event, the body. That's the thick rectangular part, and it's the heart of the candle story. It tells you how far the price moved from where it started to where it ended in a certain time frame. A big long body. That means there was a really strong, decisive move. Then you've got these thin lines sticking out from the top and bottom. We call them wicks, or sometimes shadows. Now these are super important because they show us the full battlefield. The very tip of the top wick, that's the absolute highest price that was reached. And the bottom of the lower wick, you guessed it, the absolute lowest price. Now, the color tells you the market's mood in an instant. If the candle's green, we call that bullish. It means the buyers were in control, and the price ended up higher than where it started. If it's red, that's bearish. It means the sellers won the battle and the price finished lower. It's your fastest clue for what just happened. Alright, so we've got the body, the wicks, and the color. Now let's put them all together. Every single candle, no matter what, is telling you 4 crucial pieces of information. And here they are. It's what we call the OHLC, open, high, low, and close. This is the raw data, the DNA of the candle. Open is the price right when the time period started. High and low are those extremes we just talked about with the wicks, and close is the final price right when the period ended. Okay, let's lock this in, because this is the key. The high and the lows are always easy. It's the tippity top of the upper wick and the very bottom of the lower wick. No brainer. The real difference is the body. For a green bullish candle, just think, the price went up, so it had to open at the bottom of the body and close up at the top. Makes sense, right? For a red bearish candle, it's the opposite. The price went down, so it opens at the top of the body and closes lower at the bottom. That's it. That's the secret right there. Now that we know all the parts, let's actually see one get built from scratch. Watching the price action, you know, the actual movement is where you really see the story come to life. So imagine a 5-minute timer starts. First, bam, the candle opens at a certain price. Then, maybe sellers immediately push it down, which creates that lower wick. But then, whoa, buyers storm in and rocket the price upwards, creating the upper wick. As the price bounces around, the body gets formed between where it opened and where it is right now. Then, the 5 minutes are up, the candle closes, and that final shape you're left with. It's a perfect little snapshot of the entire tug of war between buyers and sellers. It's a whole journey, in one simple shape. So, you've got the building blocks down, but before we finish, let's talk about one really special type of candle that tells a very specific and a very important story. This is a huge concept to get. Sometimes the fight between buyers and sellers just ends in a tie. The market pushes up, then it gets slammed back down and it finishes almost exactly where it began. That moment of balance, of indecision. That's what we're looking for. And that special candle is called a doji. You'll spot these a mile away because their body is just a super thin line. Sometimes there's no body at all. It just means the open price and the close price were pretty much identical. When you see a doji, it often signals that the market is feeling uncertain and a change in direction could be on the horizon. And you know, it's these kinds of detailed stories, like the indecision a doji shows, that a simple line chart just can't tell you. That is why the vast majority of traders use candlesticks. They just pack more information into a format that's easier to read at a glance. So if you're starting out, learning this language is definitely the way to go. So, there you have it. You now know the alphabet. Each candle is a letter. When you put a few together, they form words. The whole chart? Well, that's the story of the market. 1, The real question is, now that you can finally read the letters, are you ready to start reading the bigger stories? If you're a new trader and don't know where to start, please like and look forward to my next video with updated knowledge for beginners. Join my community and I'll always update you on daily gold prices, news, and the latest knowledge. Join and trade with me.